Today we'll be talking about valuations. So valuations falls into the financial pillar, and that's what we'll be talking about tonight. So without any further ado, let's go on with tonight's training topic, which is what's it worth, or business valuations. So what we're going to talk about, we're going to cover a sort of an overview of the methods of valuing a business. We're going to look at asset-based valuations, market comparisons, and financial performance. And then we're going to have a look at some reasons for valuing your business. So the obvious one is obviously if you're planning to leave the business and you're going to sell it, you need a valuation for that. But there are other reasons, and we'll explore some of those as well. And then finally, I'm going to finish by asking and discussing sort of with myself, if you like, why business valuations can be unreliable, and what factors do you need to consider if you're having a valuation to make sure that it's a true representation of what you may or may not get for your business when it comes to selling, if that is the plan. So that's what we're going to cover. Let's get on with the topic. Let me just move my piece of paper that reminds me what to talk about so I can see how long I've been going on for. I do have a tendency to go slightly over, so I need to keep an eye on the clock. So we'll start off with an overview of business valuations then. So, and we're going to look at three different methods. There are others, but these are probably the most pertinent to the garage trade. So how is a business valued? Well, it can be valued through its assets. It can be valued by market comparison, and it can be valued based on its financial performance, or more than likely a combination of these factors. So what's an asset-based valuation? Well, this assesses the value of the business tangible and intangible assets. So what do I mean by that? Well, tangible assets include the value of the land, building, equipment, tools, inventory, and any vehicles that belong to the business. So their tangible assets are the ones you can sort of touch. That's an easy way of looking at it. And the good thing about tangible assets is they're reasonably easy to value, and lots of people will agree with that valuation. We kind of know how much land is selling for in the area. We know how much buildings or commercial properties are selling for. Equipment and tools, that becomes a little bit more subjective depending on their age, condition, etc. But generally, we have an idea of their second-hand value. Now, this isn't the same value that is on your books, because on your books, this equipment and tools will have had a depreciation cycle, typically over 3 or 5 years, and they may have no actual asset value to the business, but that's for the reasons of tax, not for the reasons of selling, which is slightly different. And then what inventory do you have? Do you have any spares? Do you have any parts or other things that you use in the sort of operation of your garage business that would be of a value to or to anyone purchasing the business, and obviously the vehicles. Now they're the tangible assets, the things you can touch. Reasonably easy. A little bit tricky when it comes to equipment and the tools, lifts and stuff like that. You have to be realistic. They're not worth what you paid for them, but they're not also worth nothing if they've been depreciated on the books. Now, unlike tangible assets, intangible assets, which include, say, the value of the business brand, the relationships you have with your customers, and any intellectual property, you aren't able to touch these things. Yeah, and they can be incredibly subjective when it comes to value. And it can be argued, for example, if you say your customer base has a value. Does it in today's market? Can another garage with a very, very aggressive and active marketing campaign access all those customers? Is your black book, is your diary actually have the value that it had, say, 10, 15 years ago? I'd argue that it doesn't. But this is where intangible assets become incredibly difficult to put a value on in part of the valuation. So that's one method of valuing the business. So it's asset based. Your tangible and intangible assets. what are they worth? And someone comes along and puts a value on them. So that's the first one. Market comparison. This is often used as a guide in terms of valuations to make sure that by looking at the assets in the business, you haven't gone miles away. For example, what is a property, a commercial property selling for on that industrial estate? Doesn't matter whether it's a garage or not. What's the value of commercial property locally? And that's often a market comparison because it involves comparing the garage business to similar businesses that have recently been sold in the current market. And factors that need to be considered when you look at this include the size, location, the customer base, reputation, and profitability of the business. So you can see that when you do a market comparison, you've got to make sure you're comparing apples with apples and oranges with oranges, because a similar business may have, and this is where those intangible assets come into play, a bigger customer base. It may have more intellectual property within that business. So, and one business that's being compared with another may not be as profitable. And we'll come to financial performance as a way of valuing a business in a second. So you can see market comparison, if you like, is the way that anyone who's valuing a business keeps the valuation realistic in that location. But it's a useful guide. It helps. So if you're thinking, right, I want a rough rule of thumb, I want a reasonably accurate valuation for my business, and one very similar to yours up the road is just sold, then that's not a bad way of looking at it, as long as you are comparing like for like. If that business is, for example, leasing the building and you own your building, that comparison goes straight out the window, unless you aren't selling the actual physical building when you sell the business. Some people do, some people don't. So you've got to look at that. So the next one, financial performance, focuses on both the historical and projected financial data of the business. So what's happened in the past and what is expected to happen in the future. And the key financial revenues, or indicators, sorry, are revenue and profitability. Cash flow comes in there a little bit, as do the, if you like, the assets, because we come back to that asset-based valuation. And what happens here is that the value of the business is based on its past and future financial performance. And often what you'll see here is a business valued either on its revenue times by a multiple or its net profit times by a multiple. And you might even take into account the future ability of that business to earn, and then bring that back to today's money and say this business will be able to earn you X, Y, Z in the next 5 years, but in today's money that is actually worth this. So there are a number of ways of looking at the financial performance of a business and basing the valuation on it. So you'll commonly hear valuations based on either turnover or profit. Profit is probably a little bit more reliable, and then you'll have adjusted profit, which just makes it a little bit more complicated. But basically, anything that the current business owner is taking out of the business in terms of, let's say, pension or wages or dividends is added back to the net profit, so that when that person is no longer in the business, the true profit value is used. So that's the adjusted profit. So, and a typical multiplier for net profit, adjusted net profit for a garage business, is somewhere between 2 and 5. So we'll call it 3 because that's somewhere between 2 and 5. But that will give you an idea of a financial valuation of your business based on the actual business. Remember, if you own the building, you can add the building to it if you're selling with that, and the tangible and intangible assets. Now, I would argue the financial performance of the business includes the intangible assets, but depending on you get to value your business, they may have a different opinion. So they're the methods of valuation. So they're asset-based, market comparison, and financial. And the truth is, they will use a combination of them. They will use the financial performance, a market comparison for a little bit of sanity, and then look at the assets of the business and put a number on the business from there. So that's how it's done. Why would you want to have a business valuation other than if you are planning to end your association with that business? So we've done a training topic on this before. So if you're planning to end your association with the business, there are only three ways to end that, and that is either by selling it, you're going to pass that on or transfer ownership to somebody else, or you're going to close the business down. They're the only three exits. So a good reason for having a valuation is so you know what the business is worth now, or if you're planning for retirement, you may want to know what the business may be worth to make sure you've got enough to retire with, and we'll come back to that later on. So that is the real reason. So it also, if you have a look, if you think about it, if you think about your passing the business on to somebody, there are various ways of doing that, and you need to start these processes well in advance. I like a 10-year planning cycle with 3 threes and a spare. So if you know what you're going to be doing in 10 years time, in terms of in 10 years you want to retire, so let's say you're in your early 50s, mid 50s, and you want to be out of the business by 60s, 65, 10 years out, you can start planning how you're going to run the business over this next sort of 3-year periods in order to have the best possible valuation at the end, or if you're closing it, that you haven't started investing in the last sort of planning cycle, because it's pointless, because you're closing the business. So that's a reason for a valuation, is if you're going to sell it. But what happens if you're in a partnership and one day one of the partners decides to exit the business? It becomes crucial right then to determine the value of the business so that you can have a fair and equitable division of assets. And the valuation process, or having an idea of what your business is worth, can help avoiding potential disputes and will ensure a smoother transaction. Now, you probably, if you're in a partnership and that happens, and you've had a independent valuation reasonably sort of soon previously, not so far away, you had an independent valuation done, you have an idea, you both have an idea of what the business is worth, and therefore you can look at how you're going to divide that business up. That's one good reason for having a valuation. The other is for securing finance or investment. So if you're looking for funding from lenders or investors, having a professional valuation can enhance the credibility and provide a objective assessment of the business worth, if you like. So if you have or regularly have a valuation, and you're going to get funding or you're looking to attract investors, proving what the business is currently worth is actually not a bad idea. So people can see where you are, where you're trying to get to, and they can support you in your financing or investment goals. So they're 3 very good reasons for having a valuation. So it's never a bad idea to have one. Be careful when you go for a free valuation, because they're probably worth every penny. So and you will come back to that in a second. Normally when you get a professional valuation, it will have a cost associated with it. If it's a free valuation, that's where we're going to come into some of the areas that we're going to look at now. So what is, or what can make a valuation unreliable? Well, placing too much, if you like, stock on your intangible assets, the reputation of the business, the quality of its customer base, the skills and experience of the staff, competitive advantages and industry trends. People place a lot of store on those, but actually, what is all of that actually worth? It's very, very difficult to say. So there's one reason for unreliable valuation, is when you place too much, if you like, worth on the intangible assets. But the other reason is when the business is valued by an independent, for a reason other than a professional valuation. So if they have, for example, a vested interest in getting you to sign with them, sign an inclusive sales, they're going to probably give you the news that you want to hear when it comes to selling your business. And this is something I see time and time again. Businesses for sale somewhere between 250 and 300,000 pounds that just haven't sold. They've been for sale for more than a year, maybe more than 2 or 3 years, in some cases since before COVID. Uh, and why have they got attracted that valuation price? Where has that come from? It's because that's what people think they need to retire. And I regularly see a business with a valuation of 250 to 300,000 pounds that I can't see where that valuation has come from. If you were to look at the books, a business valuation of £300,000 requires a net profit, an adjusted net profit of somewhere around about £100,000 a year. Now, in that time that it's been for sale, if it's been for sale since pre-COVID and it's doing £100,000 a year in profit, the business owner could have realised the selling price in profit. Why are they selling? Or why are they still trying to sell it for that amount of money? Surely they'd have been better off fattening the cat at that point, doing everything they can in the business to achieve as much profit as possible, run the business down in terms of investment, and close the doors. They would have, in the same time they were waiting, they could have made a similar amount of money, I'd argue. So that is one of the reasons for having unreliable valuations. It's because the person giving you the valuation was doing it because they want you to sign up with them to get a sale, and they'll promise you the earth, yeah, and they'll say things like, we're normally turning these around in 2 to 3 months. It's a seller's market. They'll tell you there are plenty of investors looking to buy garage businesses. Well, just take a look at how many garages are for sale in your area and how long they've been for sale for, and you'll probably realize that it might not be a seller's market in the garage business. So, to summarize then, to obtain a reliable valuation, it is recommended to engage the services of a professional business appraiser or chartered accountant who specializes in business valuations. That has nothing to do with the actual sale of the business. So it's just an independent valuation done by a professional business appraiser or a chartered accountant who specializes in valuations. They can help assess your specific circumstances, gather the necessary information, and provide a more accurate valuation based on the most suitable methodology, which will probably be a combination of the methods we talked about at the beginning of this training topic. Remember, ultimately, the garage is only worth what someone is willing to pay for it. Hopefully that's made you think a little bit about how a business is valued, the reasons for getting a valuation, and some of the reasons why valuations can be a little bit unreliable, shall we say. The only true valuation ultimately is if you sell it and it's the amount that person paid. Thanks for listening. My name's Andy Crook.